started talking about MACD. MACD stands for Moving Average Convergence and Divergence. That's a big mouthful, so we all call it MACD, although I like saying Moving Average Convergence and Divergence. Now, also in tonight's class, I'm going to intermix the term security. I might say stocks, I might say Bitcoin, I might say cryptocurrency, because it just gets very boring saying asset over again. But tonight we're going to be talking about any publicly traded financial instrument. As long as it's a liquid instrument traded in the financial markets, the same criteria will apply. Similarly, I will intermix the term investing and trading. Now, we all know that an investor takes a long-term position while a trader takes a much shorter-term position. But in either case, the concepts and techniques are presented in the class are equally adept. And it just gets very, very boring saying trading. But the fact is, MACD is one of those great indicators that works in short-term and long-term markets. Now, MACD falls into the study of technical analysis. And you're all asking, should I buy this today? Should I sell this today? What will the price be tomorrow, next week, or an hour from now? Now, wouldn't investing be easy if we knew all the answers to these questions? Well, the fact is, I don't have a crystal ball. I don't have a Ouija board. So if you're attending this class in the hopes that technical analysis, and especially MACD, has the answer to these questions, I'm afraid I have to disappoint you early. It does not. But if you're attending this webinar with the hopes that technical analysis and MACD will improve your investing and trading, I got good news for you. That it surely will do for you. Now, MACD was developed by Gerald Arpel in the late 1970s. So once you think about it a little bit, you know it was developed primarily for the stock market and not for online trading. Online trading didn't exist in the 70s. Computers weren't around in the 70s. Or PCs weren't around in the 70s. And there was definitely no online trading, and there was virtually no Forex trading. There was no CFDs. So it was developed for stocks and in a much slower moving atmosphere. Back in the 70s, we all traded in the pits. We went, sat in brokers' offices. We all talked to each other. It was hard to get data, so the markets moved a lot slower. And there was no trading when the actual markets were closed. There was no after hours. There was no weekend. There weren't global markets. There was this. But as the world changed, MACD was tested and adjusted and has withstood the test of time to become one of the most well-used, well-respected indicators in Forex and CFD trading. Now, MACD helps us spot the strength, the direction, the momentum, and the duration of a trend. Now, the basic function of MACD is to discover new trends and help identify the end of a current trend. And there are various ways to gauge the signals generated by MACD, and many traders use their own unique settings and methods around this trading indicator. Now, MACD is typically placed at the bottom of the trading chart in a separate window beneath price. Now, the moving average, divergence, convergence, is an easy tool to use. However, and this is going to get the sticky part for you guys, it is crucial to understand it fully before attempting to use its signals. Now, I'm going to apologize now because MACD is actually a derivative of a derivative of a derivative of a derivative. And in order for you to learn to master and use MACD, you've got to understand each one of the lines that are used in MACD, where they come from and what they're trying to tell you. After tonight, you'll never have to do the calculations again. You'll never have to do anything because all the automatic charts will just drop MACD on your chart for you. But you can't just blindly use all these lines on the chart and not understand where they come from and what they're trying to tell you, because if you understand what they are, you'll be able to spot when they're incorrect or when they are correct. You'll be able to spot inconsistencies. and you'll understand what you're doing instead of trying to follow some orders from somebody. If you understand where it came from and what it's doing, instead of saying, okay, he told me when this happens, I should trade. Well, you should never trade that way. You should trade because you understand why this is happening, why that's happening, and then you make the decision to trade. So let's go over to a live chart. Okay. And I've got my standard teaching chart up on your screen. It's on the Euro US dollar 30-minute chart. It's the current live chart. Now, MACD starts out by using a 12 period and a 26 period EMA, exponential moving average. Now, it doesn't use a simple moving average, and unless you understand, if you understand, hopefully you do understand moving averages, an exponential moving average is a little bit more complicated calculation than a simple moving average, because it gives more weight to the most current price movement. So what is a moving average? Well, in this case, since MACD uses a 12-period moving average, it is the close of the last 12 periods. If you're looking at a 30-minute chart, it's the close over each one of the candlesticks or each one of the bars in each of those 30-minute periods going back 12 periods. Okay, and so what you would do is you would add together each one of those periods close and then divide them by 12, and that will give you the average. An exponential moving average is a little bit more involved mathematical calculation because it gives a little bit more weight to the most current price movements. Because what's more important also, the shorter the most current price movements. So in other words, hypothetically, if gold was trading at 1250, 1250, 1250, 1250, 1250, you would take 1250, back 12 closes, which would have all been 1250 divided by 12, and you got 1250. But if gold jumped 2 segments ago to 1260, and then this segment jumped to 1270, that is a lot more important than at 1250 10 periods ago. So if you use an EMA and added those together and then divided by 12, you come up with about 12, probably 52. But since it gives a little bit more weight to the more current averages, it would make it say 1257 using that formula. So that's a little bit more important. And MACD uses 2 EMAs to start out with. Because like I said, it's a derivative of a derivative of a derivative of a derivative. So what we first do is take a 12-period EMA, and we can just lay it on our chart. And that's the gold line I just popped on your chart. That's a 12-period EMA. We also add a 26-period EMA. That's the blue line I just dropped on the price chart. Now, again, this is the first step of MACD. Now, if we were just to trade these 2 moving averages, we would be trading just a standard moving average crossover strategy. But this is only the start for MACD. Now, again, if you don't understand moving averages, the 12-period moving average is considered the faster moving average, while the 26-period moving average is considered the slower moving average. Now, basically, if you understood moving averages, whenever you have 2 different periods or 3 different periods, the shorter the period, the faster it is, okay? Or it's considered, because the shorter the period, the more it reacts to the most current price. So a longer period moving average, like a 26 period, would react slower to the price move than a 12 period. That's a good thing. That's not a bad thing, because we are already using EMAs. So we've already given more weight to the current price, but now we're using a faster and a slower moving average. But we can't just use this as crossovers or on this chart, because that's a real basic moving average strategy. So as I said earlier, MACD is dropped on the bottom of your chart. And the first line we put on our chart, which I have now down below in this dark blue, is called the MACD line. The MACD line is simply a mathematical calculation of taking the gold line here and subtracting the value of the blue line. So you're taking the 12 period EMA and subtracting the 26 period EMA. And then you're plotting that difference down below. Now, on this chart down below, we have what's called a zero line. Because anytime the 12 and the 26 period EMAs cross each other, what would the difference be? They would be the exact same price at the crossover. So two exact numbers subtracted from each other will always give you 0. When the 12 period, the shorter EMA, is higher than the bigger EMA, the longer period EMA, it's going to be a positive number. So like here, we see the gold, which is a shorter period, the 12 period EMA, is higher than the 26 period. Whenever we're subtracting them, it's going to be above that 0 line. So whenever we see the line below above 0, we know the 12 period is larger than the 26 period. Whenever we see it below, we know the blue line, which is a 26, is larger than the 12 period EMA, because when you subtract a bigger number, a smaller number, and take away a bigger number, it would give you a negative number, or it would be below 0. Now, once we've plotted this MACD line, we no longer need the 2 moving averages on our chart, because this blue line down below gives you a full graphic representation of those 2 lines that we had on our chart. Those 2 EMAs are now depicted down below in what is called the MACD line. And remember, we always have the 0 line here, and we know whenever this line crosses that 0 line, that the 2 moving averages from above were crossing. They were 0. But that's only the beginning, because again, it would still be simply a moving average crossover strategy. So then we put on to our MACD line, our MACD chart below, what's called the signal line or the trigger line. This line is a 9-period moving average of the blue line. So we have the MACD line, which is the blue line, and then we take an average of 9 periods and plot that as a secondary line on our bottom chart. So you can see here, the MACD is a 12 period and a 26 period, and then a 9 period. So this gold line down below is called the signal or the trigger line. When it crosses above or below the MACD line, it signals a buy or a sell opportunity. It's a transaction signal. So whenever they cross, they are telling you something. Okay. When the blue line crosses over the gold line and above, it's generating a buy signal. When the blue line crosses over and below, it's generating a sell signal. So think of these as transaction signals or alerts, because there's a big fallacy with MACD. The MACD indicator does not take in consideration, number one, your risk management, nor does it take in consideration how far the asset will move in either direction. So when it generates the sell signal, okay, it's not telling you that it's necessarily a sell opportunity. It's telling you there's a possible sell opportunity, but not that you should actually jump in the market, because it's not telling you how far that market's going to move. So like here where they crossed over, if you would have entered here, you would have ended up losing your money, because it doesn't take into account your spread. It doesn't take into account how fast you're going to enter the market. And since it doesn't tell you how far you can expect it to go, you need to use other types of analysis to make those decisions. What it's doing is hitting you on the back of the head and saying, hey, look at this. There is an opportunity presenting itself. Okay. Now figure out if you want to take advantage of that opportunity. But again, this is still the beginnings of MACD. We have another step to go. So we've got two lines up top from the 12 period and the 26 period. They are then represented by the blue line down below. And then we have the signal line, which generates the transaction signals. Now MACD goes one step farther and adds on what we call a histogram. A histogram is simply a depiction of the two lines down below. The histogram is simply the difference between the MACD line and the signal line. Now, when the MACD line is crossing each other, when the MACD line and the signal line cross, what happens? Now remember, it's plotted on that same zero line. But when these two lines cross over each other, guess what? That signal, that histogram would be moving from red to green or at zero. When the histogram moves over zero, or the MACD line grows larger than a signal line, we can see what its depth is by seeing how high that histogram goes, or how deep the histogram goes. So this histogram represents and gives you an easy to understand visual interpretation of what the momentum of price is doing and how the trend is moving. It also helps generate overbought and oversold signals. When you have very, 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 very deep ravines or very strong mountains, most likely when it peaks above or below, you're either in an overbought or oversold condition. So we have a derivative of a derivative of a derivative of a derivative of a derivative. And this is the only time you'll ever have to calculate all this, because any other time, all you do is go up to your indicator line, locate MACD, and just click on it. And it's going to drop it on your charts just like we have here, already calculating, using a 12, 26, and a 9. Now, before we talk about how we can use this, I want to give you a little bit of a side note. The first side note is there are all types of gurus in the marketplace trying to teach you or to sell you their interpretation. Now, MACD can be very easily customized and adjusted. The 12, the 26, and the 9 are the standard MACD lines. The standard MACD calculation. The standard has withstood the test of time. The standard based on what Gerald Arpel developed. There are gurus out there that'll say, well, don't use a 12 and a 26 EMA, use a 14 and a 37 period EMA, or use a 10 period moving average signal line. Well, once that happens, it no longer follows the standard rules. Now, you can adjust it and customize it, smooth it out, get less signals, but you have to understand what you're smoothing and then do your own testing to understand what those signals will be. But it is but that's a choice that you can make. So now that we have it on our chart, let's go over back to my PowerPoint. And let's talk about what we can do with this stuff now that we have it. Now remember, the MACD histogram is simply an elegant visual representation of the difference between the MACD and its 9-day EMA. The histogram is positive when the MACD is above its 9-day EMA and negative when the MACD is below its 9-day EMA. If prices are rising, the histogram grows larger as the speed of the price movement accelerates and contracts as the price movement decelerates. The same principle works in reverse for falling prices. Now, I'm going to share with you a little presentation on using MACD, and then we're going to talk a little bit more because we've done everything to get it on your charts. We've got it on the charts, but now how do we use it? So let me pop up this little video. And then we'll come back and talk about adding it into your trading.
How fast the indicator is going to react to price change. Most of us will probably be chopped to pieces if we rely on only a short-term trading indicator as the basis for any trading system. The MACD line is faster than the signal line, and it's the result of the difference between the fast and the slow moving average. Many traders will use the line as a proxy for momentum. But to make it simpler, think of it as measuring the rate of change of price. The signal line in the MACD is slower due to its setting, and traders will often use that as a trend determination tool, either using multiple time frames or just one trading chart. And knowing that we measure trend and momentum, you may already see how we can use the MACD to actually trade with when we use both the MACD line and the signal line to alert us to possible changes in the market. The two-line cross can be a powerful indicator of trading potential in the market. Here, we've set up the indicator on our chart, and we're going to use the standard settings as we talked about earlier. And we're going to read the MACD. When we want to determine trend direction via the MACD, we can look at where the MACD line is in relation to the signal line. If the MACD line is below, in between the red lines on the chart, we're looking for a short trade. If we see the MACD line is above the signal line, between the green line, this is going to indicate a market in an uptrend, and you'd be bullish on any trading setup. And as mentioned, we're really looking at the rate of change of price. So even though the lines are crossed, price may be compressing. This is one reason that multiple time frame trading is suitable for this trading indicator. You simply look to short rallies during a MACD downtrend and buy pullbacks during an uptrend. And some traders will use the MACD signal line crossovers to buy or sell the market. You may want to consider other variables such as price structure, multiple time frame considerations, and price action in conjunction with trading a simple cross. Once the MACD line crosses over the signal line to the downside, that would be bearish, and you could use that as a signal. Conversely, if the MACD line crosses to the upside, you'd be bullish, and you can use that as a buy signal. And we talked about the fast line being a proxy for momentum, and there may be times where we will not want to wait for a complete crossover of the MACD to take a trade. So I want to draw your attention to the black round circle at the top of the chart. Here's a pin bar, and it formed after a run-up in price. Also notice the separation in the MACD indicator as price approaches the region, in the same region of previous resistance that's not really seen on this chart. And it shows decent momentum in this market. We see the separation decreasing as price slows down and then explodes to the upside, but closes on its open as seen on the pin bar. This is bearish. Now bring your eyes to the fast line of the MACD, and you can see it hooked to the downside. Given the context of price action and structure, you could gain an early entry into a possible reversal. Depending on the context of the chart, you can use the fast line hook as a buy signal or a sell signal. These can be used to enter the market or as a profit-taking indicator, but doesn't matter. Well, this is a weekly chart, and you would have entered 5 or 6 bars earlier, and you've been up over 120 pips before that breakdown happened. What about divergence? I'm not going to talk about divergence, simply because this also takes into account price action and structure. And I find the normal teachings about divergence has way too many holes, because if you trade just the indicator, you're setting yourself up for a failure. Another way that we can use this indicator is to take advantage of the zero line and the fast line as a means of trade entry. Again, keep in mind the lagging nature of all indicators with this trading method, and highly consider using multiple time frames for your trading. You can see the change in trend when during the moving average crossover, so we know we're looking for a short trade. Once the fast line crosses the zero line, this could be a trade entry. You can see how mechanical this is, but it also gets you in very late in the move. You can see on the inset on this graphic This is the daily chart, and the red line indicates where, after the weekly trend turns down, you would enter on the daily chart using the 0 line cross. That black line is where you'd enter on the weekly chart 2 months later. So in summary, with the MACD, we do have a useful technical analysis tool. It has quite a few uses, and we talked about how to determine the trend using the 2 line cross, how to read momentum using the fast line, trade entry using a fast line hook, trade entry using a 0 line cross, the benefits of multiple time frame analysis. And as with all technical indicators, you want to test this as part of an overall trading plan. Also, be aware of the lag time.
Now, MACD basically tells us 3 stories. Okay. And MACD proves most effective in wide swinging trading markets. So MACD isn't as effective in consolidated and slow moving markets. And the 3 stories it tells us is crossovers, which we've looked at quickly already. It gives us overbought and oversold conditions and divergence. Divergence alone by itself is a difficult scenario, but with MACD, when you see divergence and then get a crossover, you have something very important to look at. But first we talk about the MACD crossovers. Okay, this is what I refer to as buy or sell opportunities or transaction signals. When the MACD crosses involve the interaction of the 2 MACD lines. The MACD line is faster than the signal line, and it will typically cross above or below the slower signal line. When it crosses up and over, that is a bullish MACD crossover. When it crosses above and under, that's a bearish MACD crossover. So a bearish MACD crossover is the opposite of a bullish. When the MACD line crosses the signal line in the bearish direction, we have a bearish crossover. This hints that the price action might be entering a bearish move. So you see a bullish crossover in the circle down here, and the green circle shows the momentum when the faster MACD line crosses the signal line in the bullish direction. And then price increases afterwards. So one of the best uses of MACD in Forex trading is to identify divergence. Now, divergence is when the indicator is moving in a diverging way from price. Okay, it's easy to spot, but it doesn't really tell you what to do. It gives you an awareness. So here we see the price is moving in a downtrend. And the definition of a downtrend is lower lows and lower highs. When price is moving down and the indicator, the blue line, the MACD line, is moving in the opposite direction. So we can see the blue MACD line below is moving in the opposite direction of price. Now remember, they don't move in the same angle, but when price is falling, we would expect the MACD indicator to follow that move. But when the MACD indicator is diverging, the movement is diverging from price, we have something called divergence. And this gives us clues that price is likely to change direction. Not that it's going to, not when it's going to happen. It tells us that trend is getting into trouble. So a bullish MACD divergence occurs when the price action is moving downwards and the MACD is showing higher bottoms. In this case, the MACD indicator is giving us a strong bullish signal. Very often we will see price begin a strong upward move after a bullish divergence. Bearish divergence is the exact opposite. But as you can see on this chart that's all over the place here, that in no time does any of this tell us how steep and how long that move will continue. So think of it as hints. That's all it is hints. Okay. Now the MACD is also useful as an overbought and oversold indicator. Now, there are a lot of technical indicators or oscillators that give us overbought and oversold conditions like RSI and stochastics. Remember, an overbought market can remain overbought, and an oversold over market can remain oversold. So an overbought market doesn't necessarily mean it's going to plummet right away. It's if you're in that market, you might want to consider getting out, or you might want to revamp your stop loss or take a look at your trend. If it's an oversold market, okay, you might start to consider a buy opportunity, but not to do anything at the moment. So an overbought MACD is when the MACD line gains a relatively big distance from its signal line. So it's based on the width of the separation, or if you're looking at the histogram, the depth of the peak or the valley. In such cases, we expect the bullish move to exhaust after a strong increase and move into a bearish area. Same thing in oversold. The oversold MACD is the opposite of the overbought. Remember, in almost every indicator, they are mirror reflections of each other. There's the same thing for a downtrend as there is for an uptrend, just the reverse. Now, when you open a trade using MACD analysis, you want to protect your position with a stop loss order. To place your stop loss order effectively, you should refer to the chart in the previous action swing points, and I'll show it to you again. If you're opening a long trade, you could place your stop loss below the previous bottom in the chart. If you trade short, then you can place your stop loss order above the previous top. Now, one way to exit a MACD trade is to hold on until you receive an opposite signal. So in other words, if you were in the market and bought in the market, you would either look for an overbought indicator, or you would look for the next crossover, or as the price moved back towards that zero line. But you have to manage your own personal preferences. So remember, a MACD histogram is an indicator of an indicator. In fact, MACD is also an indicator of an indicator. That means that the MACD histogram is 4 steps removed from the price. In other words, it's a fourth derivative of price. The first derivative of MACD is a 12-day EMA and a 26-period EMA. Those are the first two calculations using the actual price on the price charts. Then we go to the second derivative, which is the 12-period EMA minus the 26-period EMA. We've moved one step away from the price chart. The third is the signal line, which is a 9-period EMA of the MACD line. And then the fourth is the histogram, which is the MACD less the MACD signal line. The base for the indicator is the securities price. It takes 4 steps to get to the actual price to the MACD histogram. It's an indicator of an indicator. Therefore, it is designed to anticipate signals in MACD, which in turn is designed to identify changes in price momentum of the underlying security. So the MACD histogram, and that's what we were just talking about, the histogram contains everything. So some people like myself, I don't use the MACD lines, I don't use the signal line, I don't use the EMAs. I use it all for the calculations, but on my chart only has the histogram, because that histogram shows you everything you need to know about price. Now, traders should always be aware that the whipsaw effect can be severe in both trending and range-bound markets, because relatively small movements can cause the indicator to change directions quickly. The large number of false signals can result in a trader taking many losses. That's because it doesn't take into consideration how far that asset's going to move. So you can get whipsawed in and out, in and out. Okay. So when you factor in spreads or commissions, the strategy can be very important. So the MACD indicator is the most popular tool in technical analysis because it gives traders the ability to quickly and easily identify the short-term trend direction. The clear transaction signals help minimize the subjectivity involved in trading and the crossovers Signal lines make it easy for traders to ensure they are trading in the direction of the momentum. So the bottom line is the strength of the current trend can be measured by channeling the MACD. Spot trend reversals by looking at divergences in momentum as measured with the MACD. Determine buy and sell signals using the MACD crossovers. You can also start using the MACD histogram for both entry and exits. In time, you'll be finding you can use it to set your stop losses and your take profits. Now, I'm going to pop up a little presentation. It's going to show you the top indicators and what would combine well with MACD on your charts.
Indicator 1, RSI. The Relative Strength Index compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an instrument. As you can see from the chart, the RSI ranges from 0 to 100. An instrument is deemed to be overbought once the RSI approaches the 70 level, meaning that it may be getting overvalued and is a good candidate for a pullback or reversal. Likewise, if the RSI approaches 30, it is an indication that the instrument may be getting oversold and therefore likely to reverse. Traders will often use the RSI either coming back out of its overbought or oversold areas as a signal or partial signal to enter a trade. As we can see, the RSI is often accurate when indicating when a market will reverse. A trader using RSI should be aware that large rallies and drops in the price of an instrument will affect the RSI by potentially creating false buy or sell signals. Traders often combine the RSI with other indicator signals, such as MACD crosses. Indicator 2, MACD. The moving average, convergence, divergence is one of the most well-known and used indicators in technical analysis. This indicator is made up of two exponential moving averages, which help measure momentum in an instrument. These moving averages and the changing distances between them become the MACD. Convergence simply means the moving averages are moving closer together, and divergence simply means they are moving away from one another. When the shorter term moving average is above the longer term moving average, this area of the indicator will show activity. When the shorter term moving average is below the longer term moving average, this area of the indicator will show activity. The center line, of which the MACD is plotted around, indicates where the moving averages are equal, and when the MACD passes through the center line, this indicates the moving average is crossing. The signal line, here in red, is a moving average of the MACD values themselves. Typical values for the MACD are 26 and 12 exponential moving averages and 9 for the signal line. The farther apart the moving average is, and the greater the momentum, the farther away the MACD will be from the center line. Traders use MACD and signal line crosses, such as these, to indicate momentum trades. You can see how these crosses often match up with market moves. Traders also use the MACD crosses to indicate when momentum is coming out of the market and may use it as a signal to exit a trade. Indicator 3, Bollinger Bands. A Bollinger Band starts off with a simple moving average. It then has two standard deviations plotted away from it. That sounds a mouthful, but the important part is because standard deviation is a measure of volatility, Bollinger Bands adjust themselves to current market conditions. When the markets become more volatile, the bands widen, move further away from the average, and during less volatile periods, the bands contract, moving closer to the average. The tightening of the bands is often used by technical traders as an early indication that volatility is about to rapidly increase, as volatility often follows periods of lack of volatility. The markets spend most of their time within the bands, and when the price action reaches the edge of the bands, it is often more likely to reverse and come back into the range. This is used as a signal by reversal traders to take a trade. This is similar to the oversold and overbought conditions of the RSI. Indicator 4, Super Trend Indicator. The Super Trend Indicator is an excellent indicator of trend direction. It can be used as a foundation of a trading system that is based on trend following. One of the most popular ways to use this indicator is to enter the market after a pullback. For example, if the market is on a downtrend, indicated by red, wait for a green pullback and then re-enter the market once it turns red again. The same can apply in uptrending markets. Here we can see how this indicator accurately tracks market trends. It can be refined through the settings to match the specific instrument. Indicator 5, Confluence. The last indicator isn't a new one, it's indicator confluence, which means to use multiple indicators and their signals to take a trade. Here we have the RSI and MACD we looked at. We have the RSI moving into overbought territory here. Remember that indicates the market will reverse. However, we want to help us filter out false signals on the RSI, so we also look at the MACD to give us confluence. We can see it is indicating the momentum has come out of the market as far as the market rallying or going up is concerned, and we have an MACD cross here. A signal to enter this short trade could be waiting for the RSI to come back out of the overbought and also waiting for the MACD cross. We can see that those combined signals are an indication that captures this trend. You can also use the opposite signals to indicate when the momentum is coming out of the market and it's more likely to reverse and the market to retrace back up the opposite direction of our trade, and therefore is an exit signal. In addition to the RSI and MACD signals, we can add further confluence to this trade with a Bollinger Band and the super trend indicator. We can see the market has hit the top of the Bollinger Band here, but we could also wait for the super trend indicator to change red here before taking the short trade. So now we have the confluence of 4 indications. We have an RSI coming back out of overbought, we have an MACD cross, we have the market going to the edge of one of the deviations on the Bollinger Band, and we also have the super trend turning back to red.
As you can see, MACD fits into a universal trading system that we can use to develop confluence to support our trading decisions. Now, there's some basic rules for trading with the MACD indicator. Consider long trades when you see a bullish MACD signal. Consider short trades when you see a bearish MACD signal. If you trade long, you should put your stop below an earlier bottom on the chart. If you are trading short, you should set your stop above an earlier trade on the chart. Hold your trades until you see an opposite MACD signal or until your stop is hit. You should use price action clues for managing potential exit points. But remember, life happens. Like trading is rarely black or white. Some rules that traders agree on blindly, such as never add to a loser, can be successfully broken to achieve extraordinary profits. However, a logical methodological approach for violating these important money management rules needs to be established before attempting to capture gains. In the case of the MACD histogram, trading the indicator instead of the price offers a new way to trade an old idea. So remember, give MACD a shot. Go to www.trade.com and open up a demo account, enroll in their education academy, and you can learn all about using MACD and other technical indicators. And thank you very much for joining us tonight. Please click on that download button and download those handouts I gave you, because like I said, they're only available during the live class. So I'm going to give you a minute to do that. And even if you're using a mobile device, just download them there and move them later. And if you want to see a recorded version of this class, you can use the link you used to come to tonight's class in about 24 hours to see an unedited version of the class. And then as soon as investing.com has had time to edit it and clean it up, you will be able to find it on the investing.com, go under the education tab, and then look on webinars on demand. And in fact, there you can go and sort all the webinars we've ever given and look up and watch whichever webinars fit your fancy. So again, thank you very much for supporting investing.com, and thank you for giving trade.com a chance to be your trading provider. Remember, anyone, anytime, anywhere with trade.com. Now, set up, you'll get outstanding market outlooks, you'll get trading signals, you'll get their advanced academy, everything you need to know and need to understand and need to learn available in one platform. So once again, thank you very much for joining us tonight, and have a great trading week. Bye now.